Well, first it dropped below $90 a barrel, then 80, then 70, now 60. Oil selling in the mid 50s. Prices dropping by almost 50% in a matter of months. What's going on, and should we be happy or worried? Two of the key questions for the bottom line tonight. Patty Croft is an economist and former senior banker. Jim Stanford is an economist with Unifor. Preet Banerjee is a freelance economics writer and broadcaster. And Amanda Lang is our senior business correspondent. Their thoughts in a moment. But first, keep these facts in mind. 10 years ago, the price of oil was in the mid-50s. 5 years ago, it had jumped to the low 80s. 1 year ago, it had topped $100 a barrel. Now, a precipitous slide, and we're back into the 50s. Every barrel of oil can mean big dollars for Canada, and we have lots of it. Proven reserves of 168 billion barrels. Only Saudi Arabia and Venezuela have more. More than 500,000 jobs in Canada are related to the oil sands alone. For every one direct oil sands job, there's one indirect and 1.5 induced. So are those jobs at risk? How low could the price go? How threatened is Canada's economy? Were governments asleep as oil tanked? Is it time to rethink our so-called most strategic economic asset? Good questions. Time for some answers. All right, should we have seen this coming, Patty?
Well, I think in part, Peter, because I think earlier this year the general agreement was that there was too much supply, largely because of what's happened in the United States with increased production. But I think the surprise happened in November, and that's when OPEC met. And the general agreement was that OPEC would cut production, and it didn't. They maintained their production quota, and after that, the game was on. In other words, oil prices began to fall, and the momentum accelerated. But I think this issue with oil right now is 80% supply and 20% demand. And that's an important distinction, because usually when we see weak oil prices, it's because of weakness in demand. But this is a supply issue.
All right, Jim?
Well, I actually think the current downturn has very little to do with either supply or demand. It's now about psychology and speculation and fear. You know, there's people out there betting on the oil price declining further. And for every dollar of actual oil produced, every barrel of oil produced, there's about 10 barrels bought and sold on the derivatives market. So now I think it's no longer a question of supply and demand. It's a question of market psychology. Hard to say where it will hit bottom. We shouldn't be surprised that this is happening, though. You know, we've had the ups and downs. It was below $10 a barrel in 1998. So if you're going to produce oil, get used to it. This is how it goes.
All right. Well, with all that being said, there's still a lot of discussion and debate about whether or not or how damaging this is to the Canadian economy. Preet, how damaging is it?
Well, according to the governor of the Bank of Canada, he said, now this was a week ago when prices were a little bit higher, that this downturn in oil was worth about 1/3 of a percentage point to GDP. But there are some positive effects as well. I mean, you probably have heard it a lot this week, people telling you how much they paid for gas at the pumps and how much they're planning to spend now at Christmas. So there are some positive effects.
But do those cancel each other off? Does one weigh more heavily on the economy?
I think that remains to be seen, because certainly there is a drag with the decreased price of oil for mainly Alberta. But if you look at Ontario and Quebec, they benefit from a lower dollar because of exports. It costs less money to transport stuff out of those provinces. And the U.S. economy is picking up steam. So as their demand goes up and it's cheaper to produce here, that's a net benefit.
Amanda?
Yeah, I mean, what I'm hearing from economists, and there's some good numbers from CIBC just today, is that net, this is negative for Canada, that the consumer benefit, which is real, it could be $11 billion next year at these prices, it doesn't actually outweigh the fact that we are overly influenced by this sector. And we're already seeing around the world up to $1 trillion in investments that will not happen in oil production. And that has a ripple through effect to jobs and business investment elsewhere. And economists are increasingly saying this will feel good in the short term, dollars in our pockets, but ultimately for Canada, this is a negative.
But I think we need to look outside our borders, though, because I think the bigger picture is this is a benefit to most of the consumers the world over. So gas-guzzling economies like the United States, like Japan, like China, like Europe, this is a benefit to them. So, yeah, small net negative domestically, but the bigger picture is this is very positive for the world economy.
All right. Well, let's break it down in terms of, for Canada, what's the most positive and what's the most negative. Let's start with what is the most positive impact that could be had. Jim?
Well, we've talked about the indirect benefits that people receive who buy oil, and that will be significant. There's industries that use energy a lot. Think of aviation, any transportation, some energy-intensive manufacturing. I think the biggest benefit will be the international benefit that Patty was just mentioning. We're going to see a downturn in the dollar that's tied to oil. That will make us more competitive. Plus, we're clearly going to see a positive boost to the U.S. economy from lower oil prices, and that is where most of our other exports go. So I think the main benefits we'll be experiencing will be through that international channel.
Did he leave anything out there, Preet, or did he cover all the bases?
Covered a lot of them, but I think the story is more that there are regional winners and losers. So again, Ontario and Quebec, they, for the same reasons that manufacturing base eroded in Ontario because of a high dollar, high price of oil, encouraging investment in the oil patch, you're seeing a reversal of that. So Alberta will probably be a net loser, but Ontario and Quebec may see a renaissance in manufacturing.
All right, most negative impact, man.
Well, obviously, it's those that are oil intensive. So we look first to Alberta, and you're already seeing the pain there. And it could be considerable if we see, for instance, the hot housing market roll over because of a prolonged downturn in prices and a pullback by businesses in hiring and spending. Saskatchewan is kind of second up, Newfoundland, Labrador. Those are the three key areas. There will be other pockets of places. We can't forget that there are businesses in Ontario that feed into these industries, right? And it's all of the kind of related service providers to the oil industry that will suffer, and they're all across the country. So there are other places too.
Patty.
When you see a drop like this, of course, it's the high-cost producers that get squeezed. So that is offshore drilling, that's some U.S. shale production, and also, of course, the oil sands. But it depends whether you're already in business or you're starting business. Because in the oil sands, a lot of the money is spent up front. So if the plant is already up and running, they can actually make money at $40 to $45 a barrel. But if it's a new project, they need about $80. So there's that very important distinction as well.
I want to point out something for the average Canadian, not necessarily industry, but in Alberta. As Canadians, we tend to have a home bias with our investment portfolio. So Canada's percentage of the world stock market is about 4%. Most Canadians have well over 50% in their portfolios. In Alberta, there's an even more concentration risk. When I go across the country to talk to investment managers, they tell me that in Alberta, people want more exposure to oil and gas. So they already have this big home bias, but there's a second level. A lot of people working in the industry have a lot of their eggs in the same basket, and that's a problem.
Jobs. We've kind of hinted at it in the pack there in terms of how many jobs are dependent on just the oil sands. Are jobs at risk with this price per barrel, Jim?
Well, some are, obviously. Not so much the jobs in producing properties, but the people who would have been hired with some of the big expansion plans that are clearly going to get shelved now. On the other hand, we are seeing, in a way, a pivoting of our economy, and we will see growth, additional growth in sectors like transportation, manufacturing, tourism, for example, will benefit from the lower dollar. And the reality is those growing sectors actually hire a lot more people. They're much more labor intensive than petroleum extraction, which is a very capital intensive business. So on a net basis, I don't think it will be a major negative for jobs. It could possibly be a positive.
I think one thing is important. Jim noted that there's a psychological aspect to what's going on now. And that is important when you think about businesses and their confidence level. This is rattling people, even in places like America where they really are kind of net beneficiaries of cheaper oil. This has got the whole world worried. And that does have a knock-on effect in spending plans, hiring plans. So we don't know yet how serious that is, but it's something you got to remember.
Governments seem to be wrestling with this, trying to decide what their strategies should be given this kind of situation. Short-term strategy, what should it be, Patty?
Short-term strategy, do nothing in terms of government policy or anything. But I think on a personal basis, I would urge people, the last thing you want to do right now is sell your energy stocks or any exposure to energy, because you're just going to realize the losses. And in some regards, this is an opportunity. If you look at energy stocks, they're
Sounding
down.
like Stephen Harper now. 2008 election, buying opportunity.
This is an opportunity. Energy stocks are down 25 to 50%, so that's a significant sale price. So you can buy something like a Canadian exchange-traded fund in the energy sector. That exposes you to 69 companies. Those are producers, pipelines, explorers. So I think there's an opportunity here that we shouldn't lose sight of.
Unless it goes down to where Jim was, reminding us not that long ago, under $10.
Yeah, and what Patty says to an individual shareholder, don't sell out in a panic, applies to us as a country. One thing I am worried about, with both the decline in energy share prices and the decline in the dollar, it suddenly looks really cheap for foreigners to come in and snap up our oil. And we're already starting to see some of the potential takeovers. Some of the companies that were over-leveraged when the oil was high are going to be very vulnerable now. I think we've got to be very careful as a country that we don't sell out a birthright, a non-renewable birthright, at a moment of crisis.
Although I hope Jim isn't suggesting that we actually kind of block the free market from functioning in a way that
Kind of like most countries in the world.
it
do.
should. We have investment review rules, and they'll kick in on sizable deals. But if this is a place where you see efficiencies occur, it happened in the last big downturn in oil prices. It's when the ExxonMobil merger happened. It happens every time. It may well continue to happen in the oil patch. I mean, I don't think we need to worry about that. I agree with Patty. No short-term response. The long term is what matters. And to me,
Okay.
this is the big wake-up call.
All right, long-term strategy then, Preet.
Well, Prime Minister Harper recently said that it would be crazy economic policy to talk about implementing some kind of emissions control at this point in time. But I would suggest that, some people would suggest that maybe it's crazy environmental policy not to. And so I would look at a policy that takes into account the fact that oil is very volatile, it's very cyclical, and the right policy, one that addresses that, not just when the time is good.
Anybody else want to tackle long-term?
Well, I mean, I would say this, the wake-up call for us is we have two major sectors, energy and finance, and we're good at both of them, and that's great, and it's been a big success. It's time to diversify beyond it, and I think we've talked before, industrial policy doesn't need to be dirty words. We can actually give some thought to what kind of economy do we want in a post-fossil fuel world. It's not a crazy concept. Whether we run out of it, move past it because of green energy, or it just becomes, too expensive. There's a bunch of reasons. What does that Canada look like? It's time to start thinking.
Okay.
And in terms of long term, I think that we do need to think about a long term energy strategy because we're supposed to be an energy superpower, but we look like the gang that can't shoot straight. Like we can't get pipelines right, we can't get plunging oil right, we can't get greenhouse gas emissions right. So we need to have a national strategy. But more directly in Alberta, they've got to have a sales tax. Like, come on. You've got to diversify your revenues. They've got a $7 billion hole they got to fill. So yeah, it's nice to live in a province with no sales tax, but that's not a long-term strategy.
Can you really see? I mean, I hear what you're saying, and you hear more and more people saying that, economists and others. But if you're a politician in Alberta, you're really going to bring in a sales tax? Or?
Well, what are the other options? You're really going to cut healthcare, you're going to cut education spending, you're going to cut all other programs that people want. They're
You
going
have
to
a
have to pay
heritage
for
fund.
it. It's tiny.
Yeah, they
Right,
dwindled it
tiny in
around
relative terms, but still you can do something with
You
it.
could
Well,
blow
it's-
through that pretty quick. I think it's
I
about
think,
$16 billion.
I think we're beginning to see the groundwork for a sales tax. When you see the Premier Prentice saying hiring freeze, spending freeze, he's basically signaling to Albertans, I'm going to make do with what you've sent me in taxes, but it's not going to be great. And at some point, that's where the conversation becomes, maybe we should send you some more. That's a rational adult conversation to have.
And I think that's exactly the conversation to have because you have this enormous wealth in the ground. And for the most part, a lot of it has been used to reduce taxes, keep taxes low. But maybe the conversation should be, well, should we make a trade-off? Should we maybe say, well, less taxes and more stability for the long term? Because Patty mentioned the Heritage Fund. It's something like $17 billion. If you look at the OPEC nations' sovereign wealth funds, it's collectively over $2 trillion.
Or Norway.
Norway is
Norway's
around $1 trillion, isn't it?
Norway's
Yeah.
almost got $1 trillion. They've got oil. They could live off the proceeds of their oil, but they
And
don't.
I-
They pay very high taxes in Norway, and they put the oil money aside.
And I guess the other issue is, especially with the parties on the right kind of getting together now in Alberta, who's going to go up against it? I mean, is the Alberta NDP, the Alberta Liberal Party, going to say no go on a sales
Well, it
tax?
depends what this new party, whatever it is in Alberta, comes out to say. And maybe they themselves will say, look, it makes absolutely no sense to fund things that you know you have to pay for year after year from royalties on a commodity that is and always will be a roller coaster. And surely that's got to be a conservative idea. So maybe they will come out and say, we need another way to fund those basic
I'm
programs.
sure they'll be excited that 5 people from Ontario are talking about their
I was born in
possibilities.
Alberta. I was born in
Yeah,
Alberta.
it doesn't wash anymore.
I've been there a few
Kind of
times.
stuff. All right, time for a quick break. But when we come back, this question: how low could the price go? And welcome back to The Bottom Line on oil. Patty, Jim, Preet, and Amanda are all on deck. Price of oil, what's your forecast? What's your prediction on how low it could go, Patty?
Right now, it's nothing about fundamentals. It's all about negative sentiment and momentum. Morgan Stanley's predicting $43, which is a very precise number for some reason, so I'm going to go with that number, 43.
All right, Jim.
$20. It'll hit $20 before it comes back up. The bigger question isn't how low it will go, but how long it will stay there. That will be the ultimate determinant
There is
of
a
the
sense
economic
that
effects.
it's not going to be one of these fastballs.
It will
There
not
could
be a fast down and up. I think it'll be there for a while.
All right, Preet.
Well, there's two types of forecasters in the world, those who don't know and those who don't know that they don't know. And I am firmly in one of those two camps. But experts, yeah, they've said 40. And I think it could get there because if you look at, everyone is expecting a cut from OPEC. And they didn't get that because the cost to get oil out of the ground in Saudi Arabia is $6 a barrel. So they can afford to squeeze out the high-cost producers for a long time, which would include the shale oil producers and people in the oil sands.
Yeah, I mean, I'll be the outlier here and say I think that we're probably pretty close to a floor here. I mean, I suppose the high 40s is maybe not unreasonable, but I disagree that we'll be here for a long time. We're already seeing enough production, planned production coming out of the system that sometime next year you get a reversal, OPEC aside. I mean, there's some level at which the world continues to consume oil and we're not producing enough of it by mid-15.
All right, I want your number one economic tips. First, for oil producers, the oil industry, really. And then for governments. And for the oil industry, Jim, first.
Diversification. We do know in oil that when the price goes down, the price at the pumps goes down, but not by quite as much. And profit margins in refining, petrochemicals, petroleum products industries tend to rise. So companies that are involved in all stages of it tend to withstand the ups and downs a bit better. And that goes for us as a country, too. We should be diversifying away just from extraction and look at more of the value added, the processing, the manufacturing.
Amanda?
I'll go back to what Jim was referring to, which is that this is a time when companies become ripe for takeover. My advice to our oil players would be the takeover players. Don't wait to be taken over. So be aggressive, go out on a limb, get the financing. It's a tough time to do it. It requires real courage. Or just fend off the takeover until your share price gets back where it belongs. But just to lie back and let the world come and buy you out on the cheap, there's no reason for us to let that happen.
All right, Patty, number one tip for government.
For government, for the federal government, I actually disagree with Stephen Harper in terms of the timing of a carbon tax. The time is now. It's perfect. Before we get too
Sure,
accustomed.
just before an election.
Yeah,
When you promise everybody, including your own
Politics
party.
aside,
Yeah.
don't get too used to paying less than $1 a liter. Put a carbon tax on. Make it revenue neutral, so any revenue that comes in goes back to consumers in payroll tax cuts or income tax cuts, and we deal with greenhouse gas emissions and maybe get a little bit of credibility in the world economy.
Preet?
100% agree. We need a policy that works not only when oil is low, but also when oil is high. So I don't think we should kick the can down the road any further. We need to start thinking about a policy that works, that takes into account the nature of oil being very volatile and very cyclical.
All right, good advice for everyone. We'll see how much of it is taken. Thank you all. Have great holidays. Thank you as well. The bottom line will be back over the holidays with a year-end review and early in the new year, a special Your Questions edition. We've received some good questions and the gang is getting their answers ready.